And we have a battery of guests joining us right now. Feroze Azeez from Anand Rathi Wealth.
Just break it down for us, for all the retail participants who are property owners who are watching the show right now. What does it really imply?
Sure. See, indexation going away definitely has an impact. Over the last 24 hours, we've seen, or lesser than that, we've seen a lot of simulations with assumptions. So I'll give you actual data because we are custodian of several clients' information. So 1,686 properties we analyzed to calculate their IRRs because we had already analyzed what is their IRR. What was their tax a day before the budget and day after the budget. This 1,686 properties were purchased at a 1,400 crore value. The current value is 3,123 crores. Okay. The indexation would have resulted in a tax for these people if all the properties were sold at 3,100 crores. The tax liability was 187. After this budget, that has gone up by 72 crores.
Wow.
For these 1,686 properties owned by 732 families. So the actual tax impact on these 1,686 actual owned properties is 39% increase in taxation for properties bought after 1st April 2001. We have eliminated those which have been bought before 2001 because if you have a property before 2001, you have to make note of this point which is called FMV, fair market value. That was not being respected before yesterday's budget. That has to be respected immensely after today's budget.
This is for properties post 2021 or pre?
2001.
2001.
2001.
Yeah, because the indexation benefits.
Because everybody's speaking of ancestral property being impacted the most, but I think ancestral property has not been impacted so much. Properties bought. Now, for example, I'll give you a practical example. A property, Crescent Bay in Parel. Bought at 3 crores 10 years back is quoting at 3.5 crores today. A 2-bedroom house.
Yeah.
A person who could have done indexation, the 3 crore value as per indexation today should have been 5.5 crores. But he's selling it at only 3.5 crores. There was zero tax. There was in fact a 2 crore tax credit to him because there is an index loss of 2 crores. So the difference for that property owner is close to 60 lakhs between these two dates. So for different properties, it's different, but ancestral properties are relatively the safer ones than the ones bought in the last 10 years, especially in metro cities. So 39% is the average increase in the taxation between the two dates.
And just to clarify, Section 54F is still applicable, right? If you reinvest it in property, you still get those exemptions.
Section 54 is more relevant for property to property.
Correct.
Section 54F is from other assets to property.
Okay.
If you take a long-term asset and invest the full proceeds back in real estate, even if your gains are not from real estate, let's assume you have an unlisted share, you made money in unlisted share, took all the gains and put it into property, Section 54F helps you save tax from other assets to real estate. Section 54 is very relevant, but they very cleverly last year capped it to 10 crores. Okay, that was earlier unlimited. Somebody could reinvest, a landowner who has got hundreds of crores of land, he could reinvest any amount of money and get the full exemption. Firstly, that was capped at 10 crores. And now reinvestment is taxed at, capped at 10 crores. That's the important bit.
37% of an uptick is quite a bit.
39 to be precise.
39.
And Feroze, you're coming to a point on principally paying tax on real returns, and that is something that this move as well is bringing about. If you'd like to elaborate a little bit more.
Avanti, what is the concept of indexation? The government empathizes that inflation has eaten away the purchasing power of your money. To the extent it actually reduces the purchasing power, you should not pay tax on it. It's not about higher tax and lower tax. On a capital asset which I've been owning from already tax paid money, which I earn, at least for the depleting portion of purchasing power, I should not be taxed, whatever that rate be. Now, for example, if my property, now 1,676 properties, we calculated the IRR, which most property builders don't calculate IRR, they always speak in multiples. So 8.1% was the IRR of these many number of properties owned by 732 families. If 6% is the inflation, the real return is 2.1% for 11-year holding period average. 11 years of holding period. So if I've made only 2% after the inflation, I paying tax on 2%, which is my real return, is so fair. Now you tax me 20%, 30%, 10%. That's not the point being made. Principally, I should pay tax on real returns, not on total returns. India's total return on their household savings is as little as 6.7%, give or take, which we computed for the 800 lakh crores. So Indian households are not even making real return on their overall portfolio. If you remove the indexation concept, not for real estate, but for all assets, you are telling people that you will have to pay tax on total return, not real return, which principally I tend to disagree.
But Feroze, just a question with respect to the overall portfolio allocation, and we were just discussing how property still forms a large part of people's saving. Going forward, will your advice and recommendation with respect to the portfolio allocation change a bit, given the kind of announcements that we have seen yesterday?
No, actually, it will not change. We have always said that residential real estate in metro cities does not compound at double digit.
True.
And I've done a study on several builders launched projects, okay, and trying to find out what is the weighted average IRR of all builders, especially the public domain builders. And double-digit
observations on DLF or Keystone?
No, I would not get there. But all I'm saying is double-digit returns in residential, apart from rental yield, is very difficult to achieve in metro cities. I'm not speaking of going to a Nagpur and buying it and then having a smaller base of 5,000 rupees a square feet, that becoming 15,000. If you in Bombay buy a property at 70,000 rupees a square feet carpet, in 10 years, if it became 2,10,000 rupees a carpet, that is 12% return. Right, 12% compounded return.
And that's not happening.
2,10,000 rupees. And as when we broke down a property's life stages, the initial 7-8 years, it appreciates a lot more, then it gets into a stagnant phase. So point is, asset allocation will not change. When I meet an HNI, we have 10,382 families. If I look at their current asset allocation, which we gather information, including real estate, the average 1/3 money is already in invested real estate other than the homes they live in. So 35% already there. My recommendation for the last 8 years for metro real estate, especially on Economic Times, at least the print, has been to stay away from them because you will not make double-digit return. And equity markets can give you double-digit return. It's not because of the bias, because they're already 1/3 is there.
So dilute that and allocate higher to equities.
That's what I would recommend, especially given the fact that there is 1/3 of the total wealth in residential. Like Sir said, one of the co-speakers said, commercial is a different ballgame. If you have the size to go into commercial, get that 66-7% rental yield. So equity for 5-year plus monies can give you double-digit returns. And if you choose a mutual fund, which we did, you can beat Nifty by about 4.3, 4.4% for the last 11 years. So 13-14%, and 12% tax. So I think residential real estate is what I'm speaking negative of, especially in metro cities. And builders are the best to judge which are the micro markets which can do well. I am no one to actually have